74% of primary residence buyers, people who are purchasing a home that they are going to live in, are financing those home purchases. And that amount goes up to 91% among first-time home buyers. So this article that we're going to be referencing throughout this podcast episode was recently released back in June 30th of 2025. But two of the biggest unknowns about home buyers, which is what we're going to be centering this discussion around, is what's the typical down payment and what is needed to enter home ownership. So we'll start with the down payment first. Out of, I will say, a large percentage of NAR, or National Association of Realtors, that were realtors that are part of the National Association of Realtors that were surveyed, a lot of them had potential buyers that believed that you need a 20% down payment in order to purchase a home. I can also say that I've come across home buyers as well who also believed that you needed a 20% down payment. So that's not accurate. We'll get a little bit more into what you actually need. But I will say the typical down payment for first-time home buyers has ranged from about 6% to 9%, dating back to 2018. So not the 20% that most people are a lot of people are thinking, I'll say, but 6 to 9% is what a lot of people are having. But you'll actually be surprised you can get into a home for much less than 6 or 9%. And I did when I bought my first home, courtesy of the loan product that I utilized during my service in the military, which was very much a benefit as well. And Jilly, you've purchased a home as well. Did you have a large down payment when you bought a home?
I did not, or else I would have never been a homeowner. I actually qualified for 100% financing.
Oh, wow.
Much like a VA loan. It was a community home buyer program or something through Renaissance Bank. And you had to have, I want to say your credit score had to have been like it was pretty, like a 660 or whatever or higher. And me and my mom, actually, we both applied, and hers was in the mid to high 7s and mine was in the low 8s at the time that I applied. So we definitely qualified. Yeah, I think where a lot of people get that 20% is conventional loan, but actually a good majority of people that I've worked with don't qualify for conventional. Well, they qualify for conventional, but they get more if they go FHA. So
yeah, the conventional standards are a little bit more strict. The credit standards are generally, you can get into an FHA loan. The down payment, the minimum down payment required for an FHA loan is 3.5%. So you can get into an FHA loan for just 3.5% of the purchase price of the home. And that's as long as you have a 580 credit score. If you're going conventional, you need at least a 620 credit score. And if you have at least a 620 credit score and you are a first-time home buyer, you could actually get a 3% down payment going conventional. So you could, 0.5% less. However, if you got a 620, 630, 640 credit score and you're going conventional, your monthly payment is going to be high because of this thing called mortgage insurance. Mortgage insurance is,
that's the part that I hate.
yeah.
I actually was fortunate because I know when you don't put enough money down or you don't have enough equity in the home going in, they make you have mortgage insurance. And I was fortunate. The loan product that I had did not have mortgage insurance, even though by all means it should have, I guess, because I put no money down. But with VA loans, is there mortgage insurance ever?
None. And that's one of the beautiful things. It's like the only loan product out there that does not have mortgage insurance out of all the traditional loan products. I should say that there. FHA, USDA even has a guarantee fee, which is their version of mortgage insurance, if you will, that you have to pay. Conventional, they all have mortgage insurance, but the VA loan does not. So,
nice.
Yeah. So, I mean, it's one of those things where it goes a lot deeper than what we're going to cover in this, episode, but a lot of factors to consider in terms of what route you take. But in terms of what we're talking about and focusing on here, as far as the down payment is concerned, 3% down payment if you're going conventional and you're a first-time home buyer, and a 3.5% down payment if you are going FHA. So those are the minimum down payment requirements there. If you're a repeat home buyer, you've already owned a home, you're not a first-time home buyer, then you can still purchase under a conventional loan with 5% down. And that's actually one of the benefits that I utilized when purchasing my second home. I actually could have used my VA loan benefits again, but I actually ended up utilizing a conventional loan, 5% down, and purchased my second home. And so it was a good thing, because I honestly was thinking it was going to be more around 15%. I personally didn't know as well myself. I was not in the mortgage industry at the time when I purchased my second home. And so I didn't know myself what that down payment needed to be. And so I was like, oh my goodness, I'm going to need all this money. What's 15% of whatever the purchase price was? And come to find out, they were like, oh no, you only need 5%. I was like, are you sure? Like just 5%? They're like, yeah, just 5%. I was like, well, I can do 5% all day. Let's go. So yeah, having that lower down payment requirement definitely does help. And then getting into that second question, because that's the typical down payment that you need, the minimum down payment that you need. The last thing I'll say before we move on, obviously the lower that your down payment is, the higher that your loan amount is going to be. The higher that your loan amount is, the more that your monthly mortgage payment is going to be. So just keep that in mind. Everybody wants the 0 down, the 100% financing, which is great. Just understand that your mortgage payment might be a little bit higher as well. Let's say if you could have a $10,000 down payment, which would equal, 3.5%. Well, actually 3.5% of a $300,000 home is $10,500. So let's say you could have that $10,500 payment, and, that you're financing the other 96.5%. If you didn't have that down payment and you financed the full 100% under, a VA loan or something like that, that $10,500 might equate to your monthly mortgage payment being about $75 higher, $80 higher on the principal and interest. Overall, if it's a VA loan, it might be a little bit cheaper because you're not going to have mortgage insurance. But, just something to keep in mind on that principal and interest, you're going to have a higher mortgage payment the higher your loan amount is. But moving on to that second part of the question, what is needed to enter home ownership? I will say that it is a lot less than what a lot of people think they need. Three main things that lenders look at when they're considering whether or not you are pre-approved to purchase a home: your credit, your income, and your debt. And that's it. They're looking at those three things. And when it comes to what you need to be able to provide, the only things that you personally are going to provide are your income documents and your assets. So they want to see how much you're making in your pay stubs and W-2s, because the W-2s are going to show that work history as well. And then they want to see those asset documents, your bank statements, if you will, or if you've got money that you're going to be taking out of an IRA or 401k, they're going to want to see that statement to see what assets you have there. If it's in a brokerage account, same thing. They're going to want to see that statement so they can see what funds you have in your brokerage account. But generally, what you need to be able to purchase a home is to be able to provide those income documents and to be able to provide those asset documents.
I don't see why y'all need all this information. Why y'all need all this information from me?
Yeah, it's a lot of information that a lot of people.
Y'all all up in my business.
You're right. And
You
to
just
that,
take my word for it and be the first one to foreclose.
and to that, I always tell people, like, you know what, you're right. And you don't need to have this $230,000 that we're trying to give you either. It's a lot of money that that you're getting loaned when you're going to purchase a home. I mean, you're not probably in your lifetime going to go anywhere else and get a loan for as much as you're about to get a loan for when you go to purchase a home. I mean, you go to your bank and ask them for $350,000 for anything. They're going to laugh at you and say, well, what are we backing this with? You got like $300 in your account and you want us to loan you $350,000?
Absolutely nothing to guarantee the loan. 1962 Chevy. Please.
But I mean, it's This is the largest purchase of your life. It is a lot of money that you are about to be borrowing. And the banks want to know that you're going to be making those payments on time and that you actually have the means to make those payments. There was a time where you didn't have to have the means. And that time was, prior to 2008.
The crash.
If you do a little bit of research, I won't go into it here, but there's a reason that 2008 happened.
Baby, you get alone and you get alone and you get alone.
Yeah, and so, everybody who's like, oh, why do y'all need all these documents? Well, do a little history, research, and you can see what happened to the economy when people didn't have to provide documentation. And banks were just loaning out money to whoever wanted it. And foreclosures rolled in, mortgage industry collapsed, real estate industry followed, and the whole economy just kind of went in the tank for a few years. So that's why all the requirements are in place. One of the requirements that came in place is what's called a ability to repay, ATR for short in the mortgage industry, but it's the ability to repay, meaning that a mortgage loan officer has to see that you as a borrower of money to be able to purchase real estate has an ability to be able to repay that loan. So they're going to want to see those income documents. They're going to want to know how long have you been working on this job? How much do you make every single paycheck? If you're not salary, how much on average are you making for your hours? How many hours on average do you work? And then how much do you make per hour? And then we're averaging that out over the last 2 years so that we can get that employment history. If you haven't been working for 2 years, you can see why it's like, okay, well, if you only been working for 6 months, it might not be enough time there for us to know how long, or how much you're actually making on average. So it's a lot of documentation requirement. I hugely simplified it when I was like, okay, you need income and you need assets, because at the end of the day, those are the two things that everything else is going to be built off of. They might be asking for verifications of employment, where they're reaching out to your employer. They might be doing a verification of assets. They might ask you for transaction history on your bank account so that they can see when you paid earnest money, did it come out of your account? And then we want to see the receipt for that. It's going to be a lot of documentation to prove all of those assets, transfer of money, how much you make. If you're self-employed, they're going to be digging into those tax returns because they're like, how much do you have in tax write-offs? And they're going to be deducting all those write-offs from your income. So if you write off all your income, you're not going to be able to qualify for a mortgage.
At all. Take it from me. At all. I'm self-employed now. I ain't got to pay no kind of taxes. I can just write everything off. Now I want to get me a house. I can't. Basically.
In general, I mean, everything centers around income and assets to help suffice, because everything else that a mortgage loan officer needs, being also that credit of those three things. When I said credit, income, and debt, when they pull your credit report, they're going to see the debt. So they're going to pull your credit report, and on your credit report is going to be listed all of the debts that you owe. So they're going to see all of that from the credit report. So everything that you're going to be providing is related to that third item, which is the income. And that's where the assets and everything come into place. So that forms the crux of it in terms of what you need to provide. But in terms of, are you ready to actually submit that application, if you will? If you've been working a job for at least 2 years and you pay all your bills on time, because credit is a factor, and if you got collections and charge-offs, then it might be a fast no. But if you're someone that's been employed for at least 2 years, or if you were in school and then you came out of school and went into the industry that you were in school for, that school time also counts as employment time. So if you've been in that situation,
that's good to know.
You said you didn't
know that. That's good to know.
Yeah, no, it does. That school time counts as employment time. So
Nice.
I've actually worked with someone who was in school, got out of school. They're like, I've only been working for a few months. And I was like, well, what were you doing before that? And they're like, oh, I was in school studying. Were you studying for the thing that you're currently working in now? Yes. I was like, okay, cool. So just send us the school transcripts that show that you were in school, studying whatever, and we're good to go. So yeah, that school time counts as employment history as well. So, I mean, when you bought your first home, was it something that, I mean, did you feel like you were ready and prepared to buy it when you got there to that point?
Oh no, I was trying to rent and I got denied for the rental. And it was during a very quiet moment when I heard God. He was like, yeah, you're going to be a homeowner. And I was like, come again? Get thee behind me, Satan. I actually thought it was the devil. I was like, there's no way God sees what's in my bank account and trying to tell me that I'm fixing to be a homeowner. So no, absolutely not. That is not what I was trying to do. That is not what I wanted to do. But I was moving here and I needed a place to stay. And I literally had no other options.
Mm-hmm.
And they were like, because you don't have a job here, you're not making any income in this state yet. Because I came from a different state to Georgia. They were like, we can't approve you for an apartment or any kind of rental. But I did have my tax returns. And so I didn't have a job here yet, but they weren't interested in employment. They just wanted to see, historically, because I was self-employed. I had been self-employed for probably 10 years prior.
Uh-oh.
So they just went by my tax returns. And then my mom had a little bit more stable income and she was willing to go on the loan with me. So
were you in the real estate industry?
I was not. I was doing hair.
Okay.
I was a cosmetologist. I had owned my own salon.
Oh,
So
nice.
that was just, yeah. Everything changed for me when I came here. Like I stopped doing that. I bought my first house, but yeah, I was not trying to purchase a house at all. And I had the money for the earnest money, which was $1,000. But then when it came to cash to close, I had no clue about any of that. And I ended up having to bring maybe like $300 or $400 to the closing table. And then they gave me like $260 back.
Oh,
So
wow.
my cash to close was very low between the $1,500 that the bank gave me and I think it was $3,500 that the builder gave me. I didn't have any closing costs. I had no down payment, and what little I did have, and I still made probably after 5.5, 6 years of living in the house, I made about $110K over what I sold it for. So
Yeah.
it was just a blessing all around. That's how you know God is in it.
Yes. No, that is awesome. I mean, so overall, you had a good experience with your home, purchase, living there, selling
Overall,
it.
yes, I
Yeah.
did. I did.
No, that's good because I will say one of the things that people have is the fear of the unknown when they go to purchase a home. Like, one of the things I hear frequently is, what if something breaks? And I try and what my answer used to be, well, that's your responsibility now. You can't call the landlord. But what I actually try to do now is let people know you've got safety nets in place, and you also, through wise management of money, can also be able to tackle anything that comes up. Hopefully you have an emergency fund in place, and I teach that to everyone that I work with is, have that emergency fund at least at a bare minimum 3 months of living expenses. So like if all income just stopped, you've got 3 months that you could tap into and nothing changes with your life because you can cover everything out of that 3 months of savings. Ideally, you want something 6 months and best case scenario, 1 year. But at a bare bones minimum, 3 months of living expenses. But having an emergency fund is something that can help you when something pops up, if something were to break, or something were to, go wrong with the house that needed to be repaired. But another thing is you got homeowners insurance. That's another thing that can help you out. Another thing is a home warranty if you end up getting a home warranty.
Yep, that's what I was about to say.
Yeah. Did you have a home warranty when you bought?
I had the 210 builder's warranty because it was a new construction. It automatically came with a 1 year labor and whatever warranty, systems and labor, and then 2 year whatever else, and then 10-year construction or whatever. So That was because it was new construction. But anytime I have like one of my buyers is buying a resale home, especially, we try to get a home warranty in there. But even if you don't get it when you purchase the house, I know of people who purchase a home warranty every year just as a supplement to their, homeowner's insurance. It's just a good thing to have to help you. Now there's so many home warranty companies out there, and there are so many that don't pay diddly squat. So you really need to you really need to do your research as to the ratings and who pays what.
I'm sorry, I didn't mean to cut you off. I had an experience.
Did you? Oh, okay.
I had an experience. You striking some chords there, but go ahead. You're doing good.
Yeah, it's a lot of them. I have not had that experience yet because, like I said, I've only owned one home thus far. But yeah, there's a lot of them that don't pay anything, and you're paying them, and even though the paperwork says, "Oh yeah, we'll do this," but then they send you through all of these conditions that you have to meet and bureaucratic red tape, and it's just like, yeah, they're not covering this, and just read the fine print, because it'll say we will replace the air conditioner, and then you read the fine print and it says up to $1,000. There's no $1,000 air conditioners out there, people.
No.
So, and then every little add-on, appliances, you can add on the plumbing systems, you can add on the HVAC. It might be more and more, but I would think that, some of these people in California and places where it's recently had the wildfires and stuff like that, where insurance companies are just pulling out of the market, hopefully the home warranty people don't follow suit, but that could be a good little supplemental alternative, because a lot of people aren't going to be able to afford the insurance, so.
Yeah, a lot of insurance companies in California were like, we're not insuring anyone here anymore. It's just too crazy. Some insurance companies were also doing the same thing in Florida, because you're getting payments for policies, and every 2-3 years Florida's getting smacked by some like major hurricane. And imagine being an insurance company where you're collecting $200 here, $200 here, and over the course of a year, that's $2,400 that you're getting for 1 year. If it's a $200 a month insurance policy or whatever, over a year, $200 a month, that's $2,400. In a year, 2 years, that's $4,800. Third year, hurricane hits, causes $15,000 worth of damage, and you haven't even collected $15,000. So everyone in Florida is just costing your business money, essentially, if for all those people that are paying less than what they're actually costing you. And insurance is one of those. I'm not gonna get into insurance. Insurance is one of them things that's just, I'm gonna leave that alone for now. We'll get to insurance in a different episode. But on your home warranty thing, home warranties can be a good supplement to homeowners insurance, because homeowners insurance kicks in certain situations, but in those situations where it doesn't kick in, that's where a home warranty can be helpful, because like, let's say a storm comes through and causes damage to your roof, homeowners insurance can help you get a new roof. But let's say that your water heater just goes out. Homeowners insurance is not going to, just come in and replace your old water heater or whatever, but a home warranty might, depending upon what's covered in your home warranty. So that's one of those things where it's like, okay, the water heater's covered in the home warranty, or the furnace is covered in the home warranty. So you can just get that if it just goes out, not as a result of a storm or hail or, whatever it might be. So home warranty can be good. But like you said, do the research to make sure that it's a good company that's actually going to pay, because I had a company really briefly that...
Yeah, I was going to say, tell us your story, Frederick.
Yeah, so just moved into the house, and the seller paid for the home warranty. It's 1 year home warranty. And And after moving to the house, drain in the sink, like literally within the first couple weeks or month of living, the drain in the sink, the kitchen sink or whatever, just was not draining. It was like this really slow drain. Called the home warranty company. They sent a guy out, put a snake down the drain, and pulled up like a towel or, paper towels or something that was in the drain. I was like, that's weird, but started draining after that. So I was like, well, I guess that was the issue. And then about a month after that, the ceiling in the basement just like fell. And come to find out, it was water that had been dripping from the refrigerator, which the kitchen sits over the room in the basement, that had just been dripping from this slow leak that we didn't even know about. Because we had just moved into the house. And so I was like, this thing had just been happening or whatever. And all of a sudden, a month and a half after we move in, ceiling just falls. And it's like, okay.
I'm glad y'all wasn't in there.
Huh?
Nobody was hurt. I'm glad y'all wasn't in there at the time.
Yeah. No one was hurt for sure. But we called the home warranty company. We're like, hey, we got this thing happen. Need to get it fixed, the ceiling and whatnot. And they were like not wanting to pay. They said, no, we don't want to pay for it. They sent us the entire check for the policy, which was only a small fraction of what it was actually going to cost to make the repair. And I was like, this is like it was like a $2,000 job, something like that. And the policy was all of like $300. It's like $325, and they're like, no, we're not going to do anything with that, but here's $325. And they sent us a check for $325, and they were like, this is how much the policy was. And as they were just trying to like wipe their hands clean of it, and I was like, you know what, I probably could take you to court because you're not even abiding by the contract of what you're supposed to be paying out. But I just chose not to go through the trouble, and instead, we just fixed it ourselves. Really, I went to I went to Lowe's and ended up getting the parts and the tools that I needed, and got a drywall lift and bought drywall and stamped it and painted. I just did it all myself. But
oh my goodness, Frederick, you're just so talented. Praise God.
No, it doesn't look professional. I mean,
did you YouTube it or you just knew what you was doing?
Oh, I did not know. I definitely YouTubed it, but
okay.
I'm like, you know what? I'm fine putting my hands to, whatever. And like, it actually looks pretty decent though. I won't talk bad about it. It looks good. But I just YouTube it, and I'm like, all right, well, I can get the tools and I can, get the materials, and I just did it myself. And it was that. I mean, it cost time, obviously, but it was the alternative to spending a couple $1,000s, which I didn't want to spend at the time. So.
Right. Yeah. And, I was going to say another thing that I found interesting in the article was how it said that a good majority of second-time home buyers usually pay more for their down payment. And I was like, I wonder why that is. And I know one big reason for it is when it comes to down payment assistance, a lot of programs, like once you sell your house, you can't qualify for that same down payment assistance, or really any down payment assistance, if your name has been on a mortgage for the last 3 years. And that's when it resets, and then you can, you become considered as a first-time home buyer again. So I was like, I wonder if that's the reason why, or if second-time home buyers, are they just saying that usually they're more prepared, they know what to expect, they save more money or whatever. What do you think about that?
Yeah, I think that actually what came to my mind was that a lot of those repeat home buyers, if they're selling their first home, have all the equity from their first home, and they're able to put that into the next home to help lower that payment. And I've seen a lot of that as well, where, they got a little bit more experience, and they're like, hey, you know what? I want that payment to be at, $1,300 a month. So I'll put 25% down so that I can get that $1,300 a month payment, or, whatever. And that way it's a little bit, freer, that they can breathe, not having a $2,000 or $2,200 a month payment, or $2,800 a month payment. But it's like, oh, okay, I got a $1,500 a month payment.
Okay.
And they know they don't have to do as much with that equity sitting there, keeping the monthly payment low. So I know that's one of the reasons, at least what I was thinking. That's the only reason I would do it. That, and I don't have anywhere else to put the money that's going to grow at a rate of return that's faster than what my home is appreciating. Because on average, homes are appreciating at about 4% year over year. And that's what it's been for the last like 60 years. But if I got an investment that's going to make me 8, 9, 10%, then yeah, I'll probably, take out more in a loan and put my money towards something else. But if I don't have that something else at the time, then yeah.
That's smart. Yeah. I get that. I feel that. Yeah.
Oh, excuse me.
Oh, bless you. Oh my goodness.
Yeah, I'll take those blessings. I guess that's my time. But no,
Yes, it is. Yes, this is a good one. Nice, short, and sweet.
Yeah, no, I think it's been good. So hopefully, people got a little bit of benefit to know that. Look, if anything, just talk to a loan officer. Have them do a soft pull on your credit. Send them your pay stubs and your bank statements and see if you can get approved. Like literally, that's it. Loan application, pay stubs, bank statements. See what you qualify for. If you don't qualify for anything, you keep renting. It doesn't change anything with your current situation. But if you do qualify, now you've got some options that you can think about. So it's worth it to take that step.
Yes.
And with that, make sure you tune in. Fridays, we'll be dropping another episode. Tuesdays, Home Finance Hacks, 7 p.m. Eastern Time, right here on YouTube. So make sure you tune in to that. And until next time, take care, be blessed, and we'll see you next week.